Hello everyone. Good morning and welcome to the Bayfort Capital monthly webinar. Thanks for taking the time today for joining us. As every webinar, we have Mr. Sunil Subramaniam with us joining in, and he will start with discussing notes on US macro, followed by me. I will be going on and discussing specifics about the AI space because that's a large part of our portfolio and some discussion on valuation of the US markets as well as the specific stocks within that to understand where the markets are. So let's get right into it. Sunil, the floor is yours.
Hi, good morning, everybody, and thanks, Ketul. So let me start off with the overall macro situation. So the first thing is that from a macro perspective, this month there's been some bad news, but there's actually good news from a stock market perspective. So what is it? It's the June non-farm payrolls, which came in much below expectation at 57,000. Market was expecting a 1,13,000 payrolls. So from that point of view, this downward revision was also for the April and May months, which the data gets corrected later. So clearly a very soft labor data, right? So that's not good news from an economic growth perspective, but from a rate hike versus rate cut expectation, clearly it makes Fed want to be supportive of growth, right? That's number one. The inflation part remains elevated in May, but as we all know that the war situation has eased, and from a peak of over 110 to $115, oil prices have now dropped below $70 per barrel. So this should reflect in the coming months' inflation data. So if you project yourself forward with a soft labor market and easing inflation, the conditions then in terms of last Fed meeting, it was a hawkish hold. It was perceived that there would be a rate hike before December. The probabilities of that were rising. But now we see that with this data comes in, and Mr. Walsh has been very clear that he's not going to go into long dot plots and give very good forward guidance. So he said he'll be very pragmatic and data dependent in his approach, right? So for example, in his last communication, the overall Fed communique from 340 words to just 130 words. And he refused to submit his own dot plot projections. And as I said, he has eliminated the forward guidance completely. So market is left to do guesswork on its own, right? And from that point of view, right, we will dwell a little bit deeper into each of these angles. But overall, remember that even with the slowing growth, the stock market earnings itself are expected to grow at a very healthy 22.5%. So this was the macro exact summary, so to speak. Let's dive deeper into each one of these, right? So first, we saw that employment stalled in June, right? So this soft June payroll reports, right, and combined with the downward revision to prior months, right, and like I said, elevated crude prices now coming down. The Fed rate hike expectation was at about 27% before the Fed meeting, and today it's dropped 10% to 17%. I'm sure as the data pans out on inflation for the month of June comes out, you will see this further drop from 17 to maybe sub 10 levels, right? So that's from a stock market perspective, that's good from a rate hike versus rate cut. Markets always love rate cuts from that perspective. The next slide goes into something like how deep is the slowdown. So, you know, the US is an aging country, and they've also, with Mr. Trump now putting curbs on fresh immigration coming into the country. So, there's a break even payroll number, right? If you want to make sure that the unemployment rate doesn't keep dropping and dropping, that number is 35,000. Now, with the print for 57,000, technically we are in that soft spot, right? Which is, I may call it a sweet spot where unemployment is dropping, but it's not going below the break-even level, right? So technically, it's sufficient to keep the unemployment rate flat. So to some extent, it is not a very worrisome labor rate drop yet. The next slide uh, tells you about the inflation expectations. Now, there are two ways of looking at this inflation. There's core inflation and there's CPI. Core is nothing but taking out food and energy from the thing. So technically, the Fed tracks the core more closely than the headline inflation, but headline is also important. So the headline, which rose to 4.2, right, clearly was food and energy. So as crude now is back to 68. Now we're talking to the West Texas light crude, right, which is for the US markets and not the Brent. So naturally, we expect that to come down. Now, core CPI, which is at 2.9, it's not affected by energy, but somewhere the softer labor data and all may also lead to a softening. That will probably critically determine whether there's a rate cut expected, right? But the rate hike on account of energy is something that the probability has dramatically reduced, right? As we move forward now to the next one, uh, right, is where is the inflation coming from? See, energy is the biggest contributor, so definitely that should make the difference. If you look at the other colored dots, right, which is the pink and the dark blue, they are all pretty much unchanged. So I think that to that extent, expecting a 2.9 plus the energy inflation, definitely it should come down to somewhere around the mid 3% from a 4.2% headline inflation, right? The next slide talks about another aspect of the labor data, right, which is the wage growth. Because it's one thing. So if you see in the graph there are two lines. There's a black line and a red line. The red line is what we just discussed, the unemployment rate, right, in terms of labor. As you saw, that unemployment rate was spiking up and then has now started tapering down, right? But if you look at the wage growth, that's consistently down. That's the right-hand side number. You can see it's come below 3.5%. So the soft wage growth, right, along with the soft payroll print, both combine to say that the economy is not overheating from a labor side. So clearly, I think that market expectations of a rate hike should cool down, and you should see the effect of this on the yields, on the 10-year yields, as well as the short-term yields, as well as the dollar itself probably will slightly weaken. Right. Go ahead. Right. But overall, from a manufacturing part of the economy, the PMI continues to remain strong. As you know, the Purchase Managing Index is a very good short-term forecaster of economic growth because these purchases would ultimately lead to production. So from that point of view, at 54, it is an expansion mode. Anything above 50 is expansion, and it's the highest reading since May. So any concerns that so it's the productivity gains which are leading to this, the labor softfall. So that's the important point to think. It's not that the wages coming down or the labor unemployment rate coming down are going to affect the production, because productivity, AI-related productivity, is starting to filter into this. So manufacturing PMI still remains strong. So that's again something, a Goldilocks scenario that you would like. You want GDP to grow well, but you don't want labor cost to go up and drive inflation, right? So to that extent, it's pointing to a good scenario from a stock market perspective. Next one. Right, we come to the stock market earnings. So in this case, as we are seeing now, that S&P 500 earnings are at 22%. Now compare this in an Indian market, which has a PE of 20 roughly, but an earning growth of 11 to 12% in the large cap space. You have American stock markets also at a similar PE, but you have an earnings growth of 22% supporting it. So there's a big difference between the two in terms of valuations. And though one can expect this to soften a bit because energy is one of the biggest gainers, and in the coming second half, you saw easing energy prices. Probably the energy companies' growth rates would come down, but still it should be in the high double digits. Is in between high teens at least is the S&P 500's growth. Now, this is the conclusion that we go to the next slide of my part of the talk. Right, it summarizes everything here, and I would focus right now only on the last line, which says that this is a compelling bull case because these are strong structural pillars. And so any bear thesis around this is hard to justify. Now, before I hand over the floor to Ketul for further, just from an Indian investor in the US perspective, I wanted to talk just for a minute about the currency situation, right? We have been seeing that the rupee has been strengthening. The reason I say is that one of the main drivers for Indians to invest in US or overseas market is the currency depreciation comes to their aid. Now, the rupee has been reasonably stable in recent times because of the RBI's actions, both in terms of curbing speculative action through the banks and the NDF market, and the money inflow into bonds, which they have now through tax breaks expanded. And for the NRIs also, they have given the SNRB hedging costs being picked up by the RBI. So it's expected to lead to, in the short run, a pretty decent flow of dollars, so that the short-term pressure on the rupee is probably expected to be less. But that being said, these are all one-off decisions and actions taken which have a time limit. So by September 30th, this whole SNRB situation will be done and dusted. Whatever money is supposed to come will come in, right? And the dollar bond inflow, yes, it will keep coming in to some extent because of the tax break. India's returns will look attractive. But one has to look at it from, let's say, a year's perspective, right? With this 3 months gone, I just want to take one set of data and show to you why FIIs, and if you look at the equity FIIs, they haven't been really coming back in strong numbers, right? Debt has seen some inflows because of the RBI and the government's actions, but equity FIIs are not really jumping yet post the Brent crude price dropping. They're not jumping yet and coming, and that's linked to the currency. So I'll just point out one. If you look at as of yesterday, what is the interest rate differential between the Indian 10-year and the US 10-year? It's 222 basis points, right? So which means that as per fundamentals of currency, right, the valuation based on which currency changes is based on the interest rate differential between the two countries. It's called the interest rate parity theory. As per that, you should expect a 2.2% depreciation in the rupee, right? But what the forward premium market are saying, yes, I looked at this yesterday's numbers, is that they're expecting, there's a swap points there. When you convert that into percentage, it says that 1 year later, the rupee is expected to depreciate 2.75%. So what does that mean is that currency markets are projecting a 2.75 difference, whereas the fundamental interest rate difference is only 222 basis points. So there's a 50 basis points greater, which means that the pressure on the rupee in the medium term, that is go past this short term, is for a depreciating rupee, right? Because the currency market is saying that I need an additional 50 basis points to cover for currency risk from India over and above the interest rate differentials. So why I'm saying this is, and that's part of the reason, there are multiple reasons to this, but you've been tracking the Indian stock market. Part of the reason for the IT bounce back, part of the reason that pharma has been a very good, because these are export oriented, which naturally benefit from a currency difference. So to summarize, what I'm saying is that the currency market is still saying that the rupee is expected to depreciate by almost 3% for the year, next 1 year, right? And it's more than the interest rate difference, which means the fundamental pull is towards a depreciating rupee. So as an international investor, right, you can expect that to translate into your NAV in India at whatever 2.75 to 3%. That should straightaway translate into NAV gains for an Indian investor investing overseas, especially the US return market. Just wanted to add that a few bits. Didn't put it, wanted to put it in a slide, but sort of talk through it in terms of this. So thank you for that. And Ketul, now over to you. I'll be here for the Q&A at the end of the session.
Thank you, Sunil, for the wonderful explanation. I want to make one point that if you have any questions, please type it in the Q&A box. At the end of my discussion, which will last for another 5 to 10 minutes only, we will take those questions and answer them. So please, anytime during the presentation, if you have any questions, please go ahead and type them in the Q&A box. Now, one of the biggest question that we receive from our investors when we meet them is AI profitable? What how is all of this going to be funded? So we are trying to address that today. How can AI become profitable, and how can this growth be sustained? Because the growth is there today for sure. Maybe 2027 also we see enough growth in AI because of the capex that is going on, as well as the earnings growth of the entire index. So can that continue beyond 2027? And for that to continue, the cost of AI has to decline and the usage of AI has to increase. Simple as that. If those two things happen, then we are in good territory, which means the earnings continue to grow as well as the usage also continues to grow. So we try to evaluate that. What is the per million cost of tokens, right? And that cost has been declining drastically. The chart that you see on the right-hand side on your screen, there are various LLM providers over there. The top one being OpenAI, the next one is Anthropic, and the green line over there is Google also. So you will see that the cost has been declining drastically. And this will continue for the next few years at least, because the underlying infrastructure that these LLMs are using, the NVIDIA chips, every year NVIDIA introduces a new chip, and the new chip is anywhere from 5 to 7x more efficient than the previous version. So these costs have to decline because the underlying chips that NVIDIA is producing, uh, their efficiency is also growing exponentially. And that's why these costs are declining exponentially. And there are some estimates that Anthropic, which is the provider of the Claude LLM model, because of their enterprise focus and because of the enterprise revenues that they have been able to generate, could become profitable in Q2 of 2026. It's a very high probability scenario. We will come to know pretty soon in the next few months whether Anthropic is profitable or not. But there is a high probability of that. So you can imagine one of the largest LLM players in the space becoming profitable within such a short period of time just shows how much the usage is increasing and how much the cost is declining. Because only when there is a combination of both of that can you become profitable. If either one of them doesn't happen, then profitability does not arise. And so that's what we are quite confident about. And these things, when they are validated in the market with Anthropic's coming out with either an IPO and disclosing its financials or making an announcement in any AI seminar somewhere, this will validate this theory that Anthropic has become profitable, and that will be a big driver for the AI stocks as well as the markets. Right. Another trend that we are seeing is that market is shifting away from the common models that were very expensive and looking at specialized models for specialized tasks, which may be much cheaper than a generic model. And so now the market is differentiating between different types of models. If you want a generic query, you can use an expensive model. If you want something very specific, you can use a particular cheaper model also. So now there are various options available to the consumers of AI. And that's always a good thing that you can choose a model based on the type of money you want to spend. Not everybody wants a 100% answer, right? Somebody is okay with a 90% accuracy answer. Somebody is okay with the 80% accuracy answer. And so they can decide if you want a 100% accuracy answer, you will be in a premium model where you will pay slightly more. And if you're okay with 70-80% accuracy, you may be in a lower rank model where the accuracy may not be that much, but that is good enough for most of the purposes. And so the cost may be drastically low. So given all these mechanics, we are quite confident that AI will become profitable fairly soon. And then, so that brings us to the revenue side. So where is the revenue coming from? According to a survey which was conducted by Jefferies in June of 2026, so very recent survey, they asked CIOs of more than 40 companies around the world, and these are the Fortune 500 companies. They asked them, where is what percentage of their spend are they doing on AI, security, public cloud, etc. And these are the results on the right-hand side. So about 36% of their spend is going to go into AI tools and features, which is the largest by far. The second largest one is security, which is at 20%. So you can see there is a wide gap between the second largest and the top spend that you see over there. So on CIOs' minds and in their expectations, AI is the largest spend item that they are going to do over the next 12 months. So clearly, there is a demand. CIOs are looking at spending at it. So from a spend perspective, we do not see any issues so far. So where can there be some issues? That's the question we frequently get. One of the issue could be in the power generation. Now, all these AI queries, they run through data centers, and data centers are simply massive power guzzlers. So if you have to provide so much power, what is the expected power requirement for data center, the demand surge, right? And that you can see over there on the right-hand side. These are just astronomical numbers. for 2027, 55 gigawatts of power is going to be required, additional power, apart from what is already available. An additional 55 gigawatts of power is going to be required for data centers only. Now, just to put this in context, what is 55 gigawatts? What is 92 gigawatts, right? If you add all the power requirement, the additional power requirement in this chart through 2029, that is the total power, installed power capacity of India in terms of thermal, hydro, and nuclear, which are the largest. That is the total installed power capacity of India. So imagine US has to add an equivalent of an entire Indian power in generation capacity over the next 3 years or 3.5 years. So that is the requirement of power. Now, this requirement of power may or may not be met because there are a lot of regulatory hurdles that are in the way. Power is not as simple as developing a software or coming along with a new LLM model. This requires physical infrastructure. It requires approvals from the regulators. And it is a complicated process because somebody has to bear the cost, and that cost has to be fairly distributed between the provider, between the data center owners who want more power. And the construct in the US in the power space is such that the cost of power is distributed equally amongst all the users. So on one hand, you want more data centers. On the other hand, you don't want the cost of power to increase drastically for regular businesses or retail consumers. So there is a fight going on right now in that space, whether who should bear that cost and how much should be the distribution between the two. And it is a state by state fight because electricity is a state subject in the US. So it is a very complicated regulatory structure, and that discussions are going on right now. It will involve the state legislatures, it will involve the US Congress, it will involve the US Senate, and effectively, finally, it will involve the US President also. So it's a major hurdle right now, and the US is effectively working towards it. So this is one of the points where we can see some issue going forward, but they are working on it, and the demand is just phenomenal. There is money to be spent, so there are companies willing to sign independent power agreements with power producers, but all of this takes time. And so that's what we are looking at. We are keeping a close watch at it. And obviously, if we see any issue, we will talk about it in the next few monthly meetings. So far, we don't see any major problem. Then comes the next part. So where is the funding coming from? Funding is not a problem. A lot of these companies, including the large data center owners, they have massive cash flow generation. Each one of them, including Amazon, Google, Microsoft, they generate more than 100 billion of free cash flow every year from their existing businesses, which they are going to put to use for AI infrastructure. So funding from the data center owners is not a problem. What about the private capital that is flowing into the technology space? We took a look at that. There you will see that AI and ML is taking up about 90% of the total private capital that is being spent on technology. So almost it's 90%, but almost all of it is going into AI. So all the private capital dedicated for technology right now is headed for AI. So definitely capital is available. Next comes the government. So US Chips and Science Act, which was introduced a few years back, is providing a 52.7 billion funding for the chips and research on AI as well as other semiconductors. So this funding is mobilizing. This is what is provided by the government, but the private capital that flows in is mobilizing a total of 630 billion in private capital overall. And so that is another big support for these markets in terms of funding. So we do feel funding is not a problem. There is an oversupply of capital in these markets. So solving the problem that can be solved with funding, those will be solved. There's not a problem over there. Then the next question we get is, okay, funding is doing good, consumption is good. Are we in a bubble in that case? Uh, our view is that we are certainly nowhere close to a bubble, primarily because this is a fundamentals driven rally. The stock prices have increased, but they have not increased in the absence of earnings. Earnings have gone up in line with stock prices. In some cases, earnings have gone up much better than the share price. So if you see the right hand side chart, the Cisco one is the one which is from the 1998 to 2000 boom, the technology boom that we had. There you will see that the earnings, which is the red line, did not keep pace with the share price. The share price went much higher in those 2, 3 years. The earnings did not grow as much. So eventually, share price had to come down and follow the earnings, which is normal. That is how math works for earnings and stock price valuations, right? Now we see that for NVIDIA, which is a very close proxy to Cisco, and people compare NVIDIA today versus Cisco in the year 98 to 2000. You will see that NVIDIA's earnings per share has done much better, which means it's the exact opposite scenario of the 98 to 2000 time frame, where right now earnings are much better than the share price. So share price has not done as well as the earnings. So that gives us enough comfort that as long as the earnings keep on growing, the share price will follow. In fact, the share prices should move higher to match the earnings growth because there is a lag in share price. So we do feel there is enough of an upside left on a lot of these AI names, in spite of those AI names having done so well so far in the last 2 years. So we are definitely far away from a bubble territory. No issues over there. So let's see, what does a bubble look like? So we have a chart over here. Yeah, this is a very important chart. You will see the P ratio. This is the forward P ratios for the top large cap companies from the 1999 era. And you will see that their P ratios were in the range of 148 to 600 plus, right? So we are far away from that. S&P 500 today is trading at about 22 P ratio. Some of the large names that we can talk about, like let's say NVIDIA over here, you will see is trading at a P ratio of 20. So there is a large gap between 20 and 100 plus P ratios that we are seeing. Not only NVIDIA, take Meta for example. This is the forward P ratio for Meta. It is 18x, right? You have Microsoft at 22, you have Amazon at 29, you have Netflix at 24. These are the magnificent seven, right? These are the darlings in the market, and they are trading at fairly reasonable valuations. Now, one can argue that there are some stocks like the recently IPO'd SpaceX, right? SpaceX is trading at a crazy multiple, more than 100 times sales. But there will always be some stocks that will trade at crazy valuation multiples. That doesn't mean the whole market is expensive. And that's what I was trying to differentiate. Yes, SpaceX is expensive because there is a big hype around Elon Musk and his plans for space. But that's a very isolated example. And maybe you can have another 10 or 15 such examples in the entire market where it is expensive. But we don't have to invest in that. If you look at the overall market level or the other large cap stocks, they are fairly cheap as far as valuations are concerned. And we are nowhere close to a bubble territory also. So we do feel this is a very good time to invest in the US markets. So here we are trying to show in this chart what is the earnings growth. The top part of the chart is the earnings growth, and the bottom part is the forward 12-month P valuation. So we always get this question that, okay, S&P is fine. What about the sectors which are considered to be in bubble territory or considered to be hyped up? So we looked at the semiconductor space. So S&P 500, the semiconductor stocks, and the 12-month forward P of Magnificent Seven and their earnings as well. So you will see the semiconductor stocks earnings have gone hyperbolic. It's a straight line up in 2025 and 2026, right? And because of that, their forward P ratio has gone down actually from 2023. If you see the forward P ratio of just semiconductor stocks, this is where the hype is, guys, right? This is not the entire index. This is not the S&P 500. This is the semiconductor part of the S&P 500, which is where a lot of hype is. The NVIDIA, the Marvels, the Micron technology, the SK Hynix, all of these are semiconductor stocks, right? So we are talking about only that sector. And even for that sector, the P ratios, the forward P ratios have declined because of this parabolic rise in earnings. So the key point over here is that we are far away from a valuation bubble because actually the valuations have declined over the last 3 years due to the earnings growth. And the same you can see for Magnificent Seven. The red line is the Magnificent Seven in both the charts. There also, earnings have not gone parabolic, but they have grown at a decent pace. And because of that, the valuation, which is the forward PE in the bottom chart, has declined consistently for the last 3 years now. So that's why we are, fighting against this theory out there that US market is in a bubble or AI is in a bubble. The data doesn't say so. Just because the stock prices have gone up in the last 2 years doesn't mean they are in bubble territory. Can they get into bubble territory? Absolutely. But that could be 3 years away, 4 years away. We don't know that. As of now, that doesn't seem to be the case. So that is what I think these are some of the big things that we wanted to discuss today. I don't think there's anything else. And now we can open up the floor for questions. So Prashant, Suman and Aishwarya from our team are there on the call. Please go ahead and take the questions that you see in the Q&A box.
Thank you for that insight. We have interesting questions from the audience. So first one is why companies with high growth like Nvidia are seemingly undervalued and not rewarded by market.
Yes, so obviously because we are far away from a euphoric time. People are worried and they look at what happened in the year 98, 2000, and that's why they are not giving crazy valuations. That's one thing. The other thing is the earnings have grown so much that it has been difficult for the stock price to keep pace because people look at stock prices, right? Even though earnings are doing well, people see that Nvidia has gone up by 300, 400% in the last 3 years, and they are not willing to give higher, stock prices. Just it's simply, I think it's a law of large numbers. Nvidia is already more than $3 trillion. So if it keeps pace with its earnings, it will go above $5 or $7 trillion. Just to give you an idea, the entire Indian market is about $3 to $4 trillion, right? So, and a single company, Nvidia, is about the size of the Indian stock market. And that's why people are not willing to, continuously increase the stock prices. And that's the only reason I see, because otherwise their revenue growth, their earnings growth is just phenomenal. Just to give you an idea, Nvidia before 2023, so in 2022, Nvidia's monthly revenues were in the $1 billion range, slightly lower than that actually, but let's round it up because the numbers that I'm going to say now are so huge that that won't matter. Monthly revenues of $1 billion before 2023. Today, they have a daily revenue of $1 billion. So you can imagine the growth in revenues. 1 billion per month versus 1 billion every day is what they are generating in terms of revenues. So how much can the stock price keep up with that? That is the question everybody is facing. We face the same question as investors, right? How much can the stock price keep on growing because the earnings, the revenues are going parabolic. So this is not just, so the revenues went from $1 billion a month to $1 billion a day. That's not the only story. Their gross margins, which were in the 60% range, they are now at 75% range. So it's not only increasing the revenues, they are increasing their margins as well. So the revenue, the earnings are just going parabolic, and the stock price is not able to keep pace with that. And that's the problem. And so we do feel that there is no issue with valuation. Now, one can say that they may be at the peak of their profit margins, and that's a valid point that their profit margins could decline in the future. But again, that could be that you could have discussed the same thing in the year 1999 also. But there, people were giving P ratios of 100, 200, 600, all the way up to 600. But today, market is much more sanguine. And so we feel that there is no problem with the overheating of the market per se. even in the sectors which are the darlings in the market, which is the semiconductor space. So, Prashant, next question, please.
So we have a next question. Like, can we see chips getting very efficient in the future that a huge capex in data center may not be needed, or will power remain bottleneck?
So there is something called the Jevons paradox, which says that as efficiency or the cost of a particular technology declines, the usage grows drastically. And that has happened with the internet, with mobile telephony, everything. So when mobile telephones were introduced, people used to pay 20 rupees per minute, 30 rupees per minute. Most of you guys may remember those days when the per minute rates were in the 20 rupees. Today, talk is almost free. You get a talk plan for on mobile telephony for free, right? But the usage has grown significantly. When only a few people could afford 20 rupees per minute, the number of people who are using it is very less. Versus now, almost everybody above the age of maybe 10 has a cell phone, right? Or maybe 12. So as the cost declines, the usage just grows parabolically. And that's what we are seeing in AI also. The costs are continuing to decline. The power efficiency is continuing to improve. The compute efficiency also is improving. Thereby, the costs are declining. But at the same time, usage is also growing because in the past, only people who could afford 20 rupees per minute were able to use AI. Now it is becoming more common. So we haven't gotten to a point where it is free for all. AI is still not that. So maybe AI moved from 20 rupees per minute to 15 rupees per minute. So we are in the first 2 years of that change. And that's why we say that the growth pathway is very long because going from 20 rupees per minute to 15 rupees per minute to 10 to 1 rupee to a few pesos per minute. That is the journey we are going to see in AI. And we are in the first 2 years of that journey. And that's why we are quite confident that there is no problem in the AI story. And the power part is definitely a concern, but it will be resolved. Because as long as there is enough funding available, issues can be resolved. It's not something that is insurmountable. There may be cost pressures over there, but those are all manageable so far.
Okay, so we have a next question. What is your view on AI regulation and its impact on big tech?
Fair point. So far, AI is not regulated, and in the near term, it won't be regulated enough because it's going at such a fast pace that it is almost impossible for the regulators to keep pace with it. Every day you see a new model coming in, every day a new announcement. It's changing so fast that it's impossible for the regulators to keep pace with it. Now, recently, one news item that caught everybody's eye was that the US banned a particular Claude model, Mythos, which was released by Anthropic. The reason for that ban was that that model is able to automatically generate a lot of vulnerabilities that you see in the internet security system or internet infrastructure, including banks. So it becomes a very dangerous proposition. So the government wanted to make sure that those loopholes are closed, those security issues are closed by the banks before this model becomes publicly available. That was the only reason they banned it. Now, I think in the last 2 days, they have made it open for everybody. It is again available. But for a brief period of time, that model was banned from public consumption because the government wanted to make sure all these security issues are resolved before they become public. So that will become on and off. But overall, the Trump administration, as a Republican administration, is fairly loose in terms of regulation. Republicans are never in favor of high regulation, tight regulation. They want free market. Republicans are always in favor of free markets. So we don't see, as long as the Trump administration is around for the next 3 years, any major regulatory issues cropping up with the AI growth.
So we have a next question. Do you think AI margins will expand or compress over time as the competition increases?
So AI margins are, it's a very generic term, right? AI margins, if you talk about semiconductors, you can talk about model providers, you can talk about applications. I think it's all over the place. There is no consistency where AI margins will increase or decrease. The chip side is where the margins are pretty huge right now. So there is a probability that the margins could decrease because they are at the peak of their margin cycles. Can that continue for 2, 3 years? Absolutely, because there is still enough demand that there is a backlog for anything that you want to order on the semiconductor space. So while margins are at the peak, they can go higher also because the demand is still there. So it is a very difficult thing to say across the board. But as of now, we are not seeing any compression in margins with any company. So far we are good.
Okay, so we have this question. If INR strengthens instead of weakening over 3 to 5 years, how much of my expected return could disappear?
Sunil, you want to weigh in on this? I think you have a detailed study.
Yes. So I don't know what is the basis for the expectation for INR to strengthen. So let me address that first. So first is that between two countries, the fundamental, like in a stock price, there's a discounted cash flow technique to arrive at the value at which a stock should trade. And there's the price at which the stock trades, which is essentially demand and supply for the stock, alternative opportunities, and all like that. Currencies behaves a very similar way. All commodities, in fact, which have earnings to it, behave the same way. So in the case of currency, what's the key thing? That there's no absolute value for currency. A currency derives its value only by comparison with another country. Okay, that's number one. Number two is, so how should the currency pair move, right? There's some fundamental logic to it. So basically it says that the fundamental rule is called PPP, purchasing power parity. What does it mean? It means that inflation between the two countries, provided the basket is the same, right, is the basis on which the currency should move. That is, country which has a higher inflation, its currency should weaken by the difference in inflation. Now, unfortunately, in practice, in fact, in the early days in the MBA schools, the way they taught currency was to use a McDonald's burger. They said compare the McDonald's burger price in various countries, and the difference in the price will tell you how much the currency should depreciate. It's just a very simplistic way of explaining, but it was used in MBA schools when I was studying. So the point I'm trying to stress is that, but the basket has to be the same. Now, unfortunately, between US and India, the type of products that people consume here and what consumes there, the inflation basket is very, very different, right? So it is not a practical thing. So what the market does, and which was the market? The market is the banks. Banks are the biggest currency traders in the world. Trillions of dollars per day and per minute are actually traded in currency. That's how huge, and banks dominate that space. What the banks then use is they use interest rate as a proxy for inflation. The real rates between the two countries, or if you take the nominal, you assume the inflation to be the same. So that's called interest rate parity principle. Now, banks all over the world use this interest rate parity to arrive at the fundamental value of the currencies, right? While the ideal is the purchasing power parity, the common market usage is called interest rate parity. Now, along with interest rate parity, there's another rule which comes into play, which is called the zero arbitrage theory. What it means is, if I am, that is, the market will not allow arbitrage without taking risk. Means what? Suppose you have a friend in the US. He has 100 rupees with him, right? Say he has $100 there. He puts it in the US. Let's say take the 10-year as a proxy. The ideal would be comparison is 1 year to 1 year. He will make 4.5% yield on his rupees there. Suppose he says, no, I'll bring those dollars to India. He puts in his wallet and brings it. And here he buys G6, takes a plane ride cost, buys G6. Indian G6 are trading at 6.7. Correct? So he says, I make 6 rupees 70 paise at the end of 1 year. 1 year later, I convert my rupee into dollar, take it back to the US. So if there is no change in the currency price, I would have made 2 rupees 50 paise extra money by just taking a plane ride from America to India and then taking a plane ride back at the end of 1 year. What risk I've taken? Nothing. I've invested in risk-free US government, risk-free Indian government. I made 250 rupees profit, or 2 rupees 2.5% profit without taking any risk. The market says, no, there is no free lunch. So there's something called a zero arbitrage theory, which says that the Indian currency must weaken by 2.5%. So that such a person who comes here and simply invests in two governments and takes the money back makes zero profit, zero loss. That's the zero arbitrage theory, which means fundamental laws of currency say the difference in interest rates between the two countries will be the depreciation of the country's rupee, which means Indian rupee, because we are at higher interest rates than the US, has to weaken by 2.5% at the current point. Depending on how the interest rate moves, the level of depreciation will change. Now, what you say that if the Indian currency strengthens, it will happen if there's an inverse interest rate ratio where US interest rates are higher than India. I don't think that's in the practical realm of possibility, because the worst case scenario for US is at 4.5%, and India's probably best case scenario is closer to 6%, right? So fundamentally, for the rupee to be strengthening, that India needs to grow fantastically with low inflation and every kind of a thing. Dream Viksit Bharat, we hope to go there, but it's not a practical reality, right? Now, what else can make the rupee? I said, no, this is the fundamentals, but there is a technicals, right? There is a demand and supply. Now, demand and supply for short periods of time, as had happened for the rupee just now, right, is that RBI artificially stops speculation. RBI says, okay, for FCNRB, I give a big, boost. The people are earning 7% from FCNRB deposits in an Indian bank compared to putting 4 or 5% that they get prior to this decision, or by investing in any US government related securities, right? So I make a super profit, 2% by putting my money back in India. These are short-term temporary things because the Brent crude price increase put pressure on the rupee. As you know, rupee has been the worst performing currency in the emerging world itself. Forget about anywhere else in the kind of for the last year, because that pressure was because of Brent crude, and FIS were massively pulling out money from India over from September 2024. These two are the technical demand supply things which countered by the RBI and the government of India to allow foreigners to invest in tax-free into Indian bonds and all of that to give salvage to the rupee. So we are fighting that two very negative over and above the interest rate differential. The flows were also hurting the rupee. So the RBI has taken action to curb those. But fundamentally, this is not going to change the interest rate scenario. So where I am coming from is that this situation till September 30th is when they are given FCNRB kind of a break, right? Now, from that point of view, after September 30th, what happens? Interest rates in FCNRB will go back to normal. Why would an NRI want to put money into India? Where will the flow? So as a temporary, you could see that actually what the RBI is doing is they softened the weakening of the rupee. So you may see in a particular point of time, it may have strengthened. That's because it had already weakened before that. Remember that. And that's why when I started my speech, I spoke about the fact that the interest rate differential today is 222 basis points, but the forward premium market is saying the rupee will weaken by 275 basis points. So there's a 50 basis points top. So technically, what you say can happen if, for example, I suddenly decide India is the darling market, that they forget about their AI craze. And they say, no, India is the darling market where I want to put all my money. So huge FII flows start coming in month on month, month on month. That's one positive. Second, our imported oil price comes down to $40, $50. So that India as a country which imports 85% oil is laughing all the way, saying very cheap oil. So it growth can jump, everything can jump. So these situations can happen. It's in the realm of probability. Percentage of probability probably very low. Can happen, and the rupee can strengthen. But that's the Eldorado world, which could be very good for investment in India because it's good, and would be negative for investing outside India. But like everybody says, don't put all your eggs in one basket. Are you going to bet against the rupee depreciating and saying it will strengthen and hence stick to only India as a thing? You would have seen in the last 3 to 4 years, India has been the worst performing market. Everybody who would have invested outside India had a better return than putting in India. So somebody who has a balanced portfolio of some portion outside India, some portion India would definitely have been better off. There are periods of time when outside markets will do better, periods when Indian markets. Whether that's due to currency or due to other growth factors, markets decide. So diversification is the answer. Don't bet against a particular long-term move and say, based on this, I will reduce my international exposure to zero, because you cannot predict these events. So my suggestion is that while there is a small probability that the rupee could actually strengthen and will be in a dream world if that happens, do not put all your eggs in one basket. As it is, you are overexposed to India as an Indian investor. So you're already betting that rupee would strengthen in taking Indian exposure. Add a overseas exposure for the chance that what the other fundamentals are saying, that the rupee is inherently a weakening currency versus the dollar. The level of weakening may change up and down. It may not, sometimes it depreciated by 13% in a year. Sometimes it may depreciate by 2%, which is in line with the interest rate depreciation. But according to me, the probability that the rupee will weaken, whether it's 2.5% or at 5-10%, depends on all these other dynamics of Brent crude and FIF flows. That's the only difference. So, as a healthy diversification of your portfolio, having a critical component in overseas securities is very, very critical, even if you're living in India, the fastest growing nation in the world. Right? I hope that slightly detailed explanation made this point to you. I'm not saying that the rupee will not strengthen for short periods of time, but over the long period, the fundamentals of interest rate theory say that Indian rupee has to be a weakening currency versus the dollar.
Okay. So it looks like we have covered all the questions from the audience.
Right.
Thank you for
Thank
your
you.
valuable insight
No,
and
there is
for
one
joining us
person,
today.
Chirag Pandya, is asking which
Okay.
sector you're looking
Okay.
good and which your portfolio, which sector you will do, or something like that. I saw. Maybe Ketul, you want to
Uh,
answer them?
okay. Yeah. So I think there are multiple sectors that are looking good. So one thing that people miss about the AI story is AI is now broadening into various sectors. And the reason for that is one is, okay, AI is doing all this processing, but for that you need semiconductors. Then you need software. Then you need power. We just discussed how much power is required. Then you need data centers, which means you need data center construction. Construction jobs in the US for data centers is now beating any other commercial construction. So data center construction is growth is faster than any other commercial construction going on in the US, right? Then you need a lot of copper. You need a lot of aluminum because data centers are copper hungry. A lot of copper is required for that. So all these metals start doing well. Power starts doing well. Data center construction, data centers do well. Construction jobs are created. All these due to all this data center construction that is required. So the entire supply chain, if you look at, there are so many opportunities across the board. It is not a narrow structure at all. For power, you need either nuclear or gas. Nuclear takes 10 years to build, so there isn't going to be a new nuclear plant coming up before the next 10 years, right? So what are your options? You go with renewables. Renewables can be fast, but renewables are not consistent. The sun may shine, the wind may blow. There is no guarantee. So, but you cannot have your data center run on intermittent power, right? You either need large batteries, which is difficult and expensive, or you need something to supplant that, which is gas. So natural gas is the fastest way to make base load power. We call it base load because it is consistently on. You can switch on gas power plants in the range of 15 minutes. You can switch on and off gas power plants within 15 minutes. A nuclear power plant to switch on and off is not a reality. It takes months to switch them on and off. Similarly, coal power plants could take a week or 10 days to switch on and off. So gas is the fastest and the easiest power plant that you can, create, construct and then switch them on and off based on the demand where, the sun doesn't shine or the wind doesn't blow. So gas is the answer. And fortunately for the US, gas is the cheapest in the world in the US because it is landlocked. There is so much gas being produced from the shale regions that they have to actually burn it. There wasn't enough commercial demand for that gas to be used. And so they were burning gas. If you see at a nighttime map of the US, a lot of parts, rural areas will be lit up like New York City because of these gas wells that are burning gas. They don't have any usage for it. So US has an abundant supply of gas for the next 300 years. Fortunately, now they find a use of it. And that's why gas power is the major growth sector for the next 5 years, I believe. So, yeah, these are some of the sectors. Then digital health, telehealth, all these are doing well. Drones are a very important sector. You saw that how Iran and Ukraine both are using drones to their benefit. So the US government has announced massive foray into drone manufacturing locally. They have actually banned DJI drones for even commercial usage and uh, just leisure. Like a kid who wants to just fly a drone outside his house, even that drones are not allowed to be imported from China. DJI is the Chinese drone manufacturing company. All Chinese drones, be it for leisure, commercial, military, no doubt about it, they have been banned in the US. So the US government is giving a big push to local drone manufacturing. So drone manufacturing involves a lot of motors, a lot of electronic parts, everything. It's an entire new supply chain altogether, right? So there are so many such sectors. Crypto is going through a big change where a lot of efficiencies from crypto are being used for reducing bank charges. Today, if you want to transfer money from India to anywhere, you pay 2 to 3% bank charges, right, for currency conversion on the higher end. On the lower end, you pay about 1%. So crypto eliminates those charges. So, and this 1% might look small, but when you are transferring hundreds of billions every year into a different currency, then that 1% becomes very significant in terms of revenues, right? So there are efficiencies being generated by crypto by providing fast rails instead of the traditional SWIFT-based money exchange networks that we are being using. So a lot of areas where there is research going on, where there's a lot of innovation going on. And that's why we feel all these sectors are poised to do very well over the next 3 to 5 years. Was there any other question? Okay, yeah, so there's one more question, that is the suppression in the S&P 500 valuation, is it because of profit booking from, to invest into new IPOs like SpaceX? I don't think so, because SpaceX, while the company itself is big at, say, $2 trillion in market valuation, the amount of money that the value of the stocks that were available to the market was 5% or so. So it was a very small IPO in terms of the market liquidity, whatever they offered to the people, right? It wasn't big. So there was no profit booking or anything to, or rather, the US market is a $80 trillion market, right? A 5 to 10 billion IPO does not impact the US market per se. So yeah, there was no reason for the profit booking in the S&P 500 to invest in these IPOs. Because these IPOs, when they come to the market, the amount of offering is very small. $5-10 billion doesn't move the markets at all. Even 100 billion will not move the market, because the entire market is $80 trillion. So 100 billion versus 80 trillion is nothing. So we don't, even if, say, Anthropic comes to market tomorrow, OpenAI comes to market tomorrow, those are so small compared to the entire market. And this is one of the most liquid market in the world, right? The US market is the most liquid in the world. So a few IPOs here and there doesn't impact the stock prices of other. It may impact within that sector. So people may move from, say, if Anthropic comes along, people may move from Google to Anthropic. Now, there you may see some different. That also, Google is so big, Google itself is at $3 trillion. So it is difficult to see any impact. But those things we have noticed when the competitors are smaller. If you have a $200 billion company or a $100 billion company and a competitor is coming up with a $10 billion IPO, then people move away from this to that. There could be some switching. But for these large companies, the impact is almost negligible.
In fact, I remember people asking during the IPO whether FII flows into India are affected because of the IPO. So I'm saying, what we are getting some 5,000 crore redemption or purchase is nothing. It's not even a rounding off, right? It's simply 8th or 10th decimal place, right? So for people to then correlate it, because the Elon Musk becoming a trillionaire and the issue that dominated the mind space. But like he said, quantum of the issue, right, is very, very small. So that's the thing. It's certainly not something that shifts the liquidity. So people get worried about these things. That's the beauty of this new Google WhatsApp University,
Well, we have one more question.
There's one
What
more
is the
question which you might want to
tax
take.
structure?
No, tax structure. Yeah, I was just saying that. What is the tax structure of your,
Yes, so
this must be about the fund, Bayfoot's fund, I think.
for Bayfort, yeah, particularly the tax structure is very simple. In the US, you are not supposed to pay capital gains, and there is no filing, no TDS, because US does not charge taxes to foreign residents. As an Indian resident, there is no tax in the US, capital gain, zero tax, no filing, nothing. In India, you have to pay taxes on foreign investments. This is considered foreign income, so you have to file, disclose this and pay taxes. The tax for any capital gains less than 2 years is your regular income bracket. So if you're in the 20% tax bracket, you'll pay 20. If you're in the 30% tax bracket, you'll pay 30% taxes. It is added to your regular income. Any capital gains generated in less than 2 years. Capital gains generated above 2 years, it goes into LTCG at 12.5%. So pretty straightforward and simple. Our firm, Bayfort Capital, sends a tax package to the registered address of your Interactive Brokers account at the end of the Indian financial year. You give that tax package to your chartered accountant, and they will be able to disclose your international income and file for taxes for that. It's pretty straightforward. And for the first 2 years, anyways, everything is short term. So you don't have to worry about anything. For the first 2 years of your new account, all the gains will be short term. And so the tax package we send, you just have to specify the amount that was capital gains. Everything will be added to your income. After the first 2 years, there will be a differentiation. Some of them will be long term, some of them will be short term. So that's the tax structure.
So we have this question from Q&A. Basically, he is asking a question. The IT sector में ये panic कब तक चलेगा? Proxies guy from Bipin.
Yes, yes. Sunil, please go ahead.
Yeah. So, so panic, देखिए panic ज़्यादा हो चुका है. Okay, if you look at the YTD performance of the IT sector, but over the last week you've been seeing some, last 2-3 days especially, you've seen some bounce back. And what's the reason for that? I will just say that, see, first of all, fundamentally, IT has moved from a growth sector to a value sector. Okay, that's a fundamental change, which was the status of the IT sector prior to COVID. During COVID, because of all this whole internet and everything got a boost, IT became a growth sector for a reasonably, what you can say, 4 or 5 year period of time. Now it's slipped back into what it was, steady income, value sector, good dividend paying stocks, right? So value seeking investors, income fund, pension funds abroad, no, they still buy IT from that perspective, because the margin of safety also is improved, saying how much correction can happen. But the panic which was driven due to AI, right? I'm not saying that's completely gone away, because this is if the moment we talk so positive about AI and the newer companies come in. See, 2 years back there was no Anthropic, right? There was no Claude. So new AI people may come up, so that like a Damocles sword, it hangs over the fact that where can AI come and hurt a typically labor-oriented, manpower-based business, which IT is. That threat will always remain. So it's why I say it will never become a growth sector back again, in my perspective. But a report by Guggenheim, which is an international analyst focusing on the IT space, has said that, and this was last week, and what it said was that, look, this correction has gone too far, because these models which are trying to project the IT services income are assuming that after 5 years they'll fall off a cliff, and as if these companies don't exist, whereas their models will be under pressure. They will have to restructure their models to a project-based pricing versus a manner-based pricing, but it's not that their business will disappear. Second is, there's a growing need for AI. In the user, companies will all want to use AI, but do they know how to use AI? How much to use AI? How many tokens to buy? What to do? How to use it? IT companies will get a new line of business around AI-related consulting for the user industries. That's a new line of business. Yes, it may not be as profitable, as long-term sustainable as their old business, but that is a new business which will come in and support. Now, the market doesn't have a way of judging how much that will come, how fast will come, and what's the model. So, but the model is not taking the account, but that will definitely come and help. So in their view, this correction was overdone. While the AI remains a threat, there's a correction has been too steep to justify that, as if these businesses cease to exist in 3 to 5 years or 7 years time. So they have upgraded most of the top leading US software companies, example was being Salesforce, right? Their target prices have been increased by anywhere between 25 to 40% from their current price. So over the last 2 3 days, you saw the US software companies suddenly rally up, and India got a sympathetic rally this last 2 days happening around the fund, plus some, like I said, some value zone people buying it. Now, what is the next step in this? This is the boost. It may last for a few days, so IT will actually do well, because the other thing being the fact that the rupee, the currency is saying the rupee should depreciate a little more than the interest rate differentials. So that's positive for a foreigner investing in Indian IT. It's a hedge against currency depreciating, so that will come. But the next trigger for this is the other than Accenture, which reported a pretty bad set of results in terms of both the lowering the guidance as well as the existing earnings. The other software company in the US, right? They will have to complete their quarterly. So that will give a signal to India, number one. Then these from 9th, 10th onwards, you're going to see TCS and Infosys and HCL and all the Indian bellwethers report. And the report is not about the current earnings. The report is about the order pipeline. The report is going to be about the guidance that they give. Are they going to keep the guidance, raise it, lower it based for the next year? Those will determine the short-term pickup or drop in the IT prices. So my suggestion is that if you're looking at it as an investment, wait for these results to come, wait for the analyst conversation come, let the market take an assessment. Taking a risk now is a very binary event, because TCS come and say everything is hunky-dory, or it could say, no, I'm tapering it down, I'm going to do something. So wait for the results to come before you take a call. But fundamentally, IT is not going to slip back into a growth sector anytime soon, but it could be a good investment from a value zone perspective for some time, especially if you are focused as a dividend yield companies. These are pretty good. So from your question was basically that when is this panic selling going to stop? Panic selling has eased. The last 2 days, actually, IT has been doing positive returns. Till the earnings is probably, it will remain in this kind of a consolidating with a positive bias zone. So I don't think the panic will, next trigger for the panic will be either a bad result by a US software company or bad guidances by the Indian software bellwethers.
Perfect. I think there is some question on the crypto part. There are multiple questions on crypto and investing in India. I think there is crypto investing in India is a gray area. So we try to stay away from it, because RBI, while does not like it, there is no code for transferring money to US dollars for crypto investments. But on the other hand, the income tax department has already come up with tax guidelines for crypto investments. So it's a little bit of a gray area. We try to stay away from it. And so we do not recommend, or we do not invest in a crypto platform in India per se. When we say we are investing in crypto, we invest in crypto platforms in the US, where there has been legislation around how it should be used, who should use it, and it's a regulated structure about investments. And so that's why we are investing in the ecosystem. We will never invest in a Bitcoin or any particular coin. We are investing in platforms or trading platforms that are allowing people to trade in crypto. We are investing in the entire ecosystem, not the cryptocurrencies per se, because that is very speculative. And we do not want to get into the realm of speculation. Where we see value in terms of earnings, cash flow generation in these platforms who allow other people to trade on crypto, there we will invest, not in the crypto currencies directly. And in India, definitely not, because it's a gray area so far.
So I think it's very similar to buying the BSE or NSE stock instead of buying stocks.
Correct. Yeah, that's very true. Yeah. So you are as the volumes of crypto grows, it's like volume trading on BSE and NSE grows, then you benefit. So it's a simple way to go through life rather than betting on the price of that crypto.
So we have this question.
What is the question?
Can we invest directly in BAI ETF?
What is this?
Yeah, I'm not aware of this BAI ETF, but yeah, I mean, as long as it's in equity, you're allowed to invest according to RBI rules. Equity and debt is allowed. If it is in crypto, if it is a leveraged ETF, all those are blocked. So you, as an Indian resident, you are not allowed to take any margin exposure, any leverage exposure, any derivative exposure. So FNO is not allowed. Commodity trading is not allowed. Currency trading is not allowed. So if that ETF is in just pure equity or pure debt, then you are able to invest. Otherwise, you are not. Okay, I think that's pretty much all the questions that we have so far. Thank you, Sunil. Thank you very much for your time today. Thank you, everyone, for joining this call. We will be doing this call again on the first Saturday of next month, and we look forward to seeing all of you again. Sunil, you have any last words to say?
No, I think it's been very good question, answer, and participation. Thanks, guys. Thanks for this active thing. I think everybody would have learned from the questions you all asked. Keep the questions coming. I think it's very, we welcome this.
Thank you very much, everyone.
Thank you.
Bye-bye.